Most investors think they missed the AI boom because they did not buy the right chip stock. That is not the whole truth. What many of them actually missed is much larger and much more durable. They failed to notice that AI is not just a software event, not just a semiconductor event, and not even just a data center event. It is an electricity event. It is an infrastructure event. It is a grid event. And once you understand that, the entire investment map changes, because the richest opportunities in a new cycle often do not sit where the headlines are loudest. They sit where the physical world has to bend in order for the headline story to keep happening. That is the real story here. People hear AI and they immediately think Nvidia, chips, cloud, model software, maybe cybersecurity if they are feeling imaginative. Fine, those are real parts of the story. But when everybody piles into the visible winners, something else happens beneath the surface. The machinery that supports the visible winners starts straining, then the strain becomes a bottleneck. Then the bottleneck becomes a budget. Then the budget becomes a national priority. And at that point, the money starts flowing not just toward the stars of the story, but toward the steel, copper, transformers, substations, switchgear, fuel cells, contractors, cooling systems, and power plants that make the stars possible. That is where adults should start paying attention. I have always thought one of the great differences between amateur investors and serious capital is where they look in a story. The amateur looks at the glamorous endpoint. The serious investor asks what inputs become unavoidable if the trend is real. If electric vehicles are real, then batteries, charging, transmission, and power generation matter. If cloud computing is real, then data centers, fiber, cooling, and real estate matter. If AI is real at scale, then electricity becomes destiny. That is what the public still has not fully processed. AI is not just creating demand for intelligence. It is creating demand for energy. And energy, unlike software, does not materialize because somebody wrote a press release. Energy lives in a brutal world of wires, permits, contractors, gas turbines, uranium supply, transformers, transmission bottlenecks, and old equipment that was never designed to support computational hunger on this scale. That is why I think the most important phrase in your source material is not actually Trump. S-energy law or executive order or even power grid crisis. The deeper line is simpler. AI is forcing a physical rebuild. That is the thing investors need to understand. The story looks political at the surface. It is industrial underneath. And industrial stories have a very different rhythm from software stories. You do not upgrade the grid with vibes. You do it with money, steel, labor, and time. That is why the opportunity set is so much larger than most people realize. The average investor still thinks in sectors because sectors are emotionally neat tech utilities. Industrials, energy materials, fine. But reality does not respect those boxes. Real capital cycles spill across categories. A boom in one visible area often creates profits in 5 invisible ones. The people who get rich from infrastructure waves are usually not the ones staring hardest at the headline beneficiary. They are the ones tracing the necessity chain. What must be built? What must be replaced? What must be supplied? What must be cooled? What must be connected? What can no longer be delayed? Those are the questions that matter. This is why I like what the underlying source was trying to do, even though I care less about the sensational wrapper than the structure beneath it. It was saying something the average retail investor badly needs to hear. The money has already started moving, and it is moving through boring channels the crowd rarely loves until the best part of the re-rating is behind them. Fay file site Fay turn 37 file 0 Fay, that is the core. Not whether one politician signed one document, not whether one speech sounded dramatic, not whether one law is leaked. The real issue is that the grid was already becoming an unavoidable problem, and AI turned that problem from slow-moving neglect into active emergency. That is a much stronger thesis, because emergency spending is different from optional spending. Optional spending can be delayed. Emergency spending gets budgeted. That is where the investment case hardens. Let us start with the grid itself. The United States built much of its power system for a different economy. a less computational one, a less digitized one, a less electricity. Hungry one, air conditioners, appliances, lights, factories. Yes, but not fleets of AI data centers drawing power like industrial cities and requiring reliability that cannot disappear just because the wind slowed down or the permitting board is still arguing over a transmission route. The old system was not built for this. It was barely renovated for the previous wave, let alone this one. That means that when AI demand collides with grid reality, the result is not theoretical. It shows up in transformer age, in interconnection delays, in capacity bottlenecks, in private power deals, in new substation demand, in the return of previously unfashionable forms of generation, in massive backlogs for contractors and equipment providers. That is how real money announces itself, not with a slogan. With waiting lists. Backlog is one of the most beautiful words in industrial investing because backlog is no longer a story. It is signed work. The market loves to talk about narratives, TAM, blue sky, opportunity, the future. Fine. I prefer backlog. Backlog says somebody already signed the check. Backlog says the customer is real. Backlog says the demand is crossed from imagination into obligation. That matters enormously in a theme like this because it separates infrastructure necessity from mere policy romance. A company with years of booked work tied to grid expansion is not living on hope the way some AI-adjacent software fantasy might be. It is living on projects that have to be executed. That is an entirely different kind of risk. The public market tends to underappreciate this kind of transition in the early phase because backlog companies do not sound sexy. Transmission contractors are not cinematic. Switchgear makers do not trend on social media fuel. Cell providers are still too industrial for the average retail investor to fall in love with properly. Cooling and thermal management are one level too boring for the headline crowd. That is exactly why I pay attention. Boring is where the money often gets serious first. Now, if you step back and map the chain properly, you can see at least 5 different buckets of beneficiaries. The first is off-grid or self-generated power. This is the most dramatic shift because it tells you the bottleneck is already real enough that private actors are routing around the system. When a data center operator stops waiting for public infrastructure and begins securing dedicated generation or specialized on-site solutions, that is not a small operational detail. That is a declaration that the traditional system is too slow for the demand curve. When that happens, investors should stop arguing about whether the trend is real and start asking which suppliers become unavoidable. Fuel cells matter here. Small modular nuclear narratives matter here. Gas generation matters here. The companies that convert fuel into localized, reliable electricity matter here. The second bucket is the physical grid builders, transmission lines, substations, grid expansion, grid modernization, power line contractors, engineering and construction firms that actually touch the hardware. These businesses tend to look dull until suddenly they do not. Then everybody notices the charts and calls it obvious. It is never obvious at the beginning. At the beginning, it looks like a modestly improving industrial. Then the orders stack, then the backlog swells. Then management starts using language that reveals the customers are no longer merely curious. They are urgent. The market eventually pays attention, but it usually pays attention later than the insiders who already live in the spending pipeline. The third bucket is the picks and shovels layer underneath the builders, power modules, switchgear, transformers, circuit protection, boards, cooling systems, thermal management, electrical distribution equipment. This is where the public often misses the best asymmetric opportunities because the names sound too technical to become emotional favorites. But once demand becomes system-wide, these component providers gain something wonderful. They can sell to multiple winners. They do not need to guess which one data center operator dominates, which one utility wins a contract, or which one energy narrative becomes the market's favorite. They only need to remain necessary to the build-out. That kind of positioning is often superior to picking the loudest symbol in the most fashionable layer. The fourth bucket is raw materials and enabling inputs: copper, aluminum, uranium. In the nuclear path, specialized fuels. The public tends to mock commodity-related investing because commodities sound old, economy, and messy. But every infrastructure cycle eventually rediscovers a simple truth: the physical world cannot be upgraded without physical stuff. If the build-out is large enough, upstream supply matters. If policy, tariffs, or domestic production preferences distort the flow further, certain producers can become both infrastructure plays and geopolitical plays at the same time. That layering is powerful. The fifth bucket is what I would call continuity generation, plants that were supposed to retire but now must remain. Capacity that was unfashionable but now is indispensable. Coal and gas, not because they are elegant but because they are dispatchable. This is a place where ideology often loses to reliability. Data centers do not care about political aesthetics when uptime is non-negotiable. Governments eventually remember this too. Once power reliability becomes a national economic issue, the system starts rewarding whoever can provide steady electrons, not just clean headlines. This is one of those moments when investors must decide whether they want to be morally theatrical or financially literate. I prefer literacy. Now let me say something that will frustrate many people, but it is true. Most investors are not actually too late when a theme has already moved. They are too vague. That is a different problem. A stock up 50% can still be early if the spending cycle is just beginning. A stock up 150% can still be rational if the installed base is tiny relative to what is required. A company on its second leg up can still be less risky than it was at the first leg because the evidence base is stronger. Now, this is something amateurs constantly misunderstand. They think already up means already over. Often it simply means already discovered. Discovery and exhaustion are not the same thing. In fact, I would rather invest after reality has begun proving itself than during the period when only the most imaginative people can still tell the story with a straight face. Early is overrated if early means speculative. I like to be early enough to matter and late enough to have evidence. That is a much better zone. This is why backlog signed power purchase agreements, public capex commitments, supplier order books, and visible infrastructure strain matter so much. They are evidence. They transform a theme from maybe into must. And must is one of the best words in investing. The government side matters too, but not for the reason most people think. The public gets hypnotized by executive orders because politics makes a better thumbnail than procurement. But the order is not the entire story. The order matters because it can accelerate, protect, legitimize, or prioritize spending already being forced by underlying economics. It is not creating the electricity problem out of nothing. It is responding to a power reality that industry already feels. That means the policy tailwind is additive, not foundational. I like that much more. A policy only thesis is weak. A policy accelerated physical necessity thesis is much stronger. That is what this is. Now I want to talk about the biggest mistake retail investors make with themes like this. They memorize a list that is useless. The list matters for a moment, then the world changes. Prices move. Leadership rotates. New suppliers emerge. Old names get overround margins. Surprise contract timing slips. A great theme can still produce terrible returns if you buy the wrong expression of it at the wrong price with the wrong understanding. That is why what matters is not the list. It is the framework. And the framework here is simple enough to carry into future cycles. Start with an undeniable macro force, ask what physical bottleneck that force creates, then ask which businesses get paid not for being associated with a story, but for reducing the bottleneck, then ask who already has backlog, real contracts, and operational proof. Then ask where the market still has not fully connected the dots. That is how adults follow capital, not by chasing loudness, by tracing necessity. This applies not just to this moment, but to almost every serious investment wave. The public always focuses first on the most glamorous layer. Then later, it discovers that the less glamorous layers were often where the steadier and sometimes larger fortunes were made. Railroads did not only reward the train dreamers, the internet did not only reward the websites, the smartphone cycle did not only reward the handset brands. Once a platform wave gets large enough, its supporting architecture becomes investable in its own right. AI is now there. That is the real message. Not that energy law is exciting, that AI has crossed from a software story into an infrastructure story. And infrastructure stories have long tails. Now, let me make this practical. If I were thinking about positioning around this theme intelligently, I would not build the portfolio like a fanboy. I would build it like a capital allocator. I would want some exposure to the obvious grid, build winners with real scale, backlog, and execution capability. I would want selective exposure to the off-grid or on. Site generation names that may win because the traditional grid timeline is too slow. I would want exposure to one or two component suppliers whose products become necessary across multiple categories of build-out. I would want to understand the material layer, especially where domestic production, tariff advantages, or supply tightness can create a second order tailwind. And I would want to avoid becoming so emotionally committed to any one narrative that I stop respecting valuation, competition, project timing, or capital intensity. That last part matters because infrastructure euphoria can still produce foolish behavior. Just because the spending is real does not mean every beneficiary will make money equally. Some companies will win contracts and still destroy shareholder value through overexpansion, bad acquisitions, margin slippage, or terrible capital discipline. Some names will get bid to ridiculous multiples because the market discovered them all at once. Some stories will sound like picks and shovels and still turn out to be promotional junk. That is why evidence must stay ahead of enthusiasm. This is another reason I like the follow the money instinct embedded in the source, but I would refine it. Do not merely follow headlines about money. Follow actual bottlenecks, actual backlog, and actual capital commitments. The more layers of reality under the trade, the better. And finally, let me say something about timing. People always want to know whether the move already happened. That is usually the wrong question. The right question is whether the spending cycle is just beginning to broaden. A trend can be underway for months and still be early. In the only sense that matters, the actual dollars have not yet fully worked their way through every layer of the industrial stack. A name can double and still not reflect a multi-year capex regime if the market is only starting to see the size of the opportunity. That is not a guarantee. It is simply a reminder that price action alone is not a calendar. What matters is where we are in the money flow. And here, the money flow says something very clear. The grid is no longer just a utility problem. It is becoming a national capacity problem. AI did not invent electricity demand, it weaponized it. That means the people who still think this is merely an AI stock story are probably looking in the wrong place. The real winners may not be the company selling the dream. They may be the company selling the physical permission slip that lets the dream keep running. That is where I would want to stand. Not in the crowd chasing the obvious winners after CNBC tells them why the move already happened. I would rather stand one layer down where capital becomes steel, backlog becomes revenue, necessity becomes margin, and boring businesses become unexpectedly important. That is where serious money often gets made, not where the future is advertised, where the future has to be wired, cooled, fueled, and built.